We have a very peculiar way of looking at things. We want to buy something that's intrinsically a very good business, meaning that an idiot could run it and it would do all right. And then we want that business, which an idiot could run successfully, to have a wonderful person in it running it. And if we have a wonderful business with a wonderful person running it, that really turns us on, and it works very well. And now we do make exceptions, but not many. It's a pretty simple philosophy. Warren sometimes says you have to choose good person or good business. You know what he says? And this is not politically correct. He says good business. He wants something that has such tremendous strength. I had a friend when I practiced law, and he said, if it won't stand a little mismanagement, it's not much of a business. And we like businesses that stand a lot of mismanagement but don't get it. So that's our formula. And we can't make it work perfectly, but it certainly worked better than most people's. And we reject some wonderful businesses with some wonderful people where it's just too tough.
Yeah.
If the business is tough enough, it has a way of staying tough. As Warren says that when a business with a reputation for being tough and a manager with an opportunity for being brilliant get together, he says it's the reputation of the business that remains. And if they start tough, they stay tough.
The best business, I believe, is one that doesn't have to invest capital, but earns a perpetuity growth annuity. Right? Asset management's a great business if you can invest the assets well and you can get paid a fee, off a base of assets of other people's money. But there are other businesses that meet that model. So Tim Hortons is a franchise restaurateur. They have a brand, they have a system, and then the franchisees put up the capital, and they get a royalty on every, coffee and donuts that's sold at Tim Hortons. Universal Music is a royalty on people listening to music. Hilton is a royalty on people staying in hotels. They own a brand, other people put up the capital. So most of the companies we invest in can be thought of as annuities or growth royalties. And the key is it's predicting which of these royalties will endure. And that's a more complicated question. Well, I think Uber is precisely that, right? They don't pay for the cars, and they don't do the driving, right? They have a system, they've got a platform, they've got a user interface, and they aggregate all that demand, and then they get a royalty. Let's call it 20% of the ride in exchange for delivering the demand. That's an amazing business. Again, if you can have confidence that the Uber platform will be the platform a decade from now and 2 decades from now.
So you like what you call super durable companies. Define what you see as super durable.
Well, the value of a financial asset is the present value of the cash it generates over its life. How can you build a DCF model unless you can predict those cash flows? So the business has to endure. And we try to find things we never need to sell, and we try to find businesses that can grow forever. There aren't that many of them, so that's why we own such few companies.
Say you only get one good idea a year.
1 or 2, if we're lucky, yes, but that's enough.
We don't have any notions as to what we want to buy based on how their costs are segmented. What we really are looking for is an enduring competitive advantage. I mean, that's what's going through our mind all the time, and then we want, obviously, top-notch people running the place, because we're not going to run them ourselves. So those are the 2 factors we look at. We want to understand the cost structure, but Charlie and I can understand the cost structure of many companies. There's many we can't, but we can understand them of a good many companies. And we don't really care whether we're buying into a people-intensive business, a raw material-intensive business, a rent-intensive business. We do want to understand it and understand why it's got an edge against its competitors.
To some extent, we're like the hedgehog that knows one big thing. If you generate float at 3% per annum and buy businesses that earn 13% per annum with the proceeds of the float, we have actually figured out that that's a pretty good position to be in.
It took us a long time.